Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on trading the gap with the market guys. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your toolbar. Also, if you are experiencing some audio difficulties, you can click on that sound check link in your audio panel or the settings link as well, and the setup window may show up on your secondary screen if you are using two monitors. Everyone is muted for sound quality purposes, and if you find that some of the audio is not clear on your end, you are always welcome to log out and call in by using your telephone, and don't forget to enter that PIN number when you do enter the session again. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. So we did get a chance to use this toolbar right here. I just want to highlight that there are some other icons you can take advantage of. One is the arrow icon, as you see here. What that really does is show or hide the control panel. From time to time, GoToWebinar does automatically hide the control panel, so you may not be able to access it. So feel free to click on that arrow icon to expand it. And also you can view in full screen mode and also raise your hand by using the hand icon. And as always, feel free to type in any of your questions or comments in the question panel, and our presenter will address them as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access our past webinar recordings on our Webinars on Demand page under the Learn and Do More section of scotiaitrade.com. You are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that the handouts panel will not show up until the end of the session, and you can click on that blue link to download the presentation. And our presenter today is AJ Monty. He's a chartered market technician with over 30 years of experience in the financial industry. He currently serves as chief market strategist for the Market Guys, teaching professionals and novices alike innovative techniques to accumulate and protect wealth. He's also one of the more recognized financial experts in the industry, thanks to his appearances on ABC, Fox Business, and PBS Television, as well as a regular guest slot on Serious Money Radio. AJ has authored 2 financial education books and is known internationally for his financial educational seminars. Welcome, AJ.
Thank you very much, Rose, and welcome everyone to today's session, which is really something that builds on the last session. So if you were not able to make the last presentation, what I'll do for you is I'll just kind of review some things so that you're not falling behind or feeling out of sorts. So we at the Market Guys are actively educating investors around the world, not just in the U.S. and Canada and throughout North America, but around the world. And it's very interesting to see the results that we're getting from people. We often get emails from folks kind of giving us an update on their progress and what they've learned, and many success stories. One gentleman who I'll just mention first name, his name is Paul, lives in London. After working with the concepts that we've taught over the last 3 years, he's actually been able to quit his full-time job and actually trade from home as he and his wife raised their new baby daughter. And that's one of the more moving success stories that I've heard, because, you know, when I was speaking with Paul, and he was telling me about how it took him 3 years to build up his account to be able to trade regularly, I asked him, well, what do you think your single most important point that you've learned over the years? And he said, gap trading, without a doubt. And then he added to that, he said, well, it's not just learning how to trade the gaps, but it's knowing how to manage the risk when a trade moves against you. And he said, you know, I'm in a position now where I can't afford to take a catastrophic hit because my family's dependent upon me now, and if I were to take a big hit, I would have to go back to the office and start working again. So that would take me away from my family. So the lesson here in me telling you about Paul is that he has put a very high stake on his not managing risk. So in other words, if he doesn't manage risk correctly, he has a lot more than just money to risk. He has time away from his family and a change in his lifestyle. Now, I can't say everyone is going to be able to achieve the same level as Paul with regard to being a full-time trader, but gap trading doesn't require your having to sit in front of a computer all day long. It's a beautiful thing because you could actually, after the market closes, you could scan the markets. You don't need open markets or data clicking in front of you all over the place. You just have to be able to identify the gaps. And nowadays, the technology has even allowed us to stock screen, and look for gaps. So the computer is doing that for us. So, of course, I take my role as a financial educator very seriously, but I could only hope that you take your role as an investor or money manager for your family also very seriously, because this isn't a game. This isn't gambling. This is basically analyzing price action, understanding human behavior and how that applies to the markets, and then being able to more or less take advantage of that and exploit the profits from the market as we look for these signals. Now, I don't know if a question is going to come up about options, so I thought I'd throw this slide up there just in case someone asks me a question towards the end about options. I'm a big option trader. I love putting the odds in my favor, and as I talk about these concepts, please understand, like Rose mentioned, these are recorded, these sessions, they're for educational purposes only. So if you're trying to trade off of something I'm showing on the screen right now, that wouldn't make too much sense, because by the time you're listening out there in the future into the recording, that stock is probably going to have moved already. So that's my my screen there. You could read the rest on your own. I don't have to dictate that to you. So we want to go over just some quick review. This might even seem almost too basic, but it's important to understand the three different trends in the market. It's not just the bulls taking control of the prices higher or the bears pushing it lower. There's also a neutral trend where things go sideways, and there's been many stocks lately over the past year that have been doing just that. They've been trading within a well-defined trading channel. But first, remember, the buyers are in control in a bull market, and they're the ones that create the demand, because for them it's all about greed, really, and I mean that in a good way, actually, not the greedy negative aspects of money, but greed is actually a big and main component that drives prices higher, because people are getting into a stock because they want to make money. A case in point, yesterday I put out a trade recommendation to our client base, our subscribers, and I can tell you now that it's happened already, but we bought into JNUG, which is a junior ETF. It's a less expensive way of buying into the gold mining companies without having to buy into GLD or Barrick Gold or anything like that. It's a very inexpensive way, and we bought the stock right around $10, and today it just went up like crazy. When the rest of the market had dropped, this particular contract went up. So the buyers, again, were in control today. But here's the big point, and why technical analysis is so important. I knew it was going to go up today based on what I saw yesterday and the day before. And you too, when you exercise and hone these technical analysis skills, you will most likely have the same percentage of accuracy as I have currently. And it's not rocket science, it's not voodoo magic, it's not tea leaves and trying to tell the future of a person's personal life. No, I can with great accuracy predict the future, because the buyers, and again, I'm still in this upward trend here of the slide, because the buyers display certain behavior patterns, and you can see right on the technical charts what they're almost thinking. And one of the things the buyers do before they take control is they wait for the sellers to release control. Now I'm going to move down to the second bullet point here. Who are the sellers? Well, the sellers are the people that push prices down, and they're in control of the overhead supply. So let's say each and every one of you had many millions of dollars invested in a particular stock. If you had too much supply and you were more fearful, again, there's that word fear right in the middle there. If you were more fearful of that position and holding on to that stock, you might want to release some of that overhead that you have. You might want to go out there and lighten up on some of the position and sell some of that portfolio, which in turn pushes prices down. Now, the interaction between the buyers and the sellers here is again what we read on these charts. Before any intelligent and seasoned or experienced buyer jumps in to buy, they first wait for the sellers to stop selling because they know they have inventory. They're not going to get in until the sellers have completely exhausted their supply of whatever stock that is, and then the buyers start to move in. Well, in a neutral market, you still have those components that I've mentioned between the buyers and the sellers, but the only difference in the neutral market is that the action and reaction of these two sides, the buyers and the sellers, are more narrow. It's not a dramatic up move, a dramatic down move, and nor is it sustained to be in any one direction. So it kind of flounders in a sideways trading channel. And it really doesn't matter which market we're in, bullish, bearish, or a neutral market. We could make money in any market, depending on which side you basically put your money on. That's really all it is. Now, keep in mind, this is an interactive session. Rose, I just want to make sure, can you see the GoToWebinar control panel, or is that free from the screen? Just want to make sure.
It's free from the screen.
Okay,
I
good.
can't see it.
Okay, because I want to be able to monitor the questions. If you do have a question along the way, type it into the question answer box down there, and Rose and I will be monitoring that. We'll make sure that we include that in there into the presentation. So, all right. So now we know the up market, down market, sideways market, but what just happened there? Okay. So we now have to look at what might disrupt the flow of those trends. See, this is where we go from understanding what the trends are to reading what affects the markets once they're established. And I think each and every one of us have been exposed to at least one or maybe more of these different effects. But you have most likely seen a stock move in a dramatic way after an analyst's opinion comes out. And it might come in the form of, okay, we put a different price target on this one. We still think it's going to go higher, but we don't think it's going to go as high. Well, although the analyst still is bullish on the stock, if we were in a bull market trend, again, controlled by the buyers, an analyst opinion like that, where they lower their price target, but the price target is still higher than where the stock is actually trading, believe it or not, that's taken as a negative. I've always been fascinated by this. Here's an analyst. Let's say a stock is trading $30. They put it the analyst puts out a price target, last quarter at 100. So here it is trading 30. They put a price target at 100. Then the analyst comes in to readjust their target, and they lower their target from $100 to $80. And remember, the stock is still trading $30. Guess what happens? It drops. I just, because it's perceived that that's a negative. Even though it's still a positive target, it's perceived by the general public to be a negative bit of news. So it shocks the market. It shocks it. And this causes extreme price movement, and there are, believe it or not, there are signals that are given even before the analyst opens up their mouth to change the price target. You see, what I'm teaching you is how to read the charts and how to disseminate and understand the fundamentals at times. I do talk fundamentals every now and then. And so what I teach you is what the analysts are looking at. So if I tell you there's a bearish indicator showing up on the chart, you already know that stock is going to drop ahead of time. The analyst knows that pretty much when you do, if you're looking at the same charts. But a day or two or three or maybe the week after, the analyst lowers their price target because of that signal. See, by then you're already out of the stock. Or you might already be into the stock looking to make money on the way down through a short position. But my point is, these are the events or behavior patterns that disrupt the flow of money coming in or out of the market. Now, corporate announcements are fairly common. They usually come up every quarter, when they're announcing their financials. Many times a corporation will come out and say, okay, we're going to have a conference call right after we release the earnings. Now, sometimes that alone is taken as a negative because the general public is thinking, wow, the earnings are going to disappoint and they're going to come out after the market to explain why. So people are already selling. It's crazy. It really is crazy. The behavior patterns of the general investor and even in the community of professional traders, it sometimes doesn't make sense, but it's important for you to understand what drives the behavior. And these are just some of the things that do. Now, economic events, one of the biggest concerns, I would have to say right now in the U.S. and even in the rest of the world is world economies and interest rates. Right now, interest rates are at historic lows, and they're still hovering at historic lows when interest rates really should not be this low. But the reason they are is because countries have taken on so much debt that if they start increasing interest rates, what's going to happen? It's going to increase the cost of carrying that debt, which ultimately will be a negative impact on the economy. So that is something we all have to pay very close attention to, because if all of a sudden the Federal Reserve here in the U.S. makes an announcement on interest rates, again, that could disrupt the flow of money and cause a shift that will ultimately create gaps in the market, which I'll get to in a couple more slides. Again, remember, this presentation is all about gap trading, but you need to understand what drives the gaps before you can learn how to trade them and even profit from them. Okay, politics. Oh boy, let me go back there. Politics. Some of you may be following the very embarrassing, I will say, the embarrassing presidential debates as these candidates go for each other's throats. But there were some very important things said in the first the first presidential debate that I want to point out to everyone. Donald Trump, whether you like him or not, has made a lot of money in business. So he follows economic trends quite closely. He follows what the Fed does. He follows interest rates. And he mentioned something that kind of flew over the heads, I believe, of most of the people in the audience who were listening. He said, we're in a bubble. And he used that word. Now, when you have someone of prominence or at least celebrity, anyone who has a big audience, when they start talking bubbles, you better pay very, very close attention to that, because I totally agree with that. But no one is really focusing their discussions on what could possibly happen if the bubble bursts. Now, my personal and expert opinion tells me the bubble is about to burst. And please don't be afraid of that. If that scares you, then chances are you just are not using the right strategy. I look forward to the bubble bursting because in the markets, there are so many ways to make money on the way down. It's ridiculous nowadays. Back in the 80s, we had hardly any way to make money on the way down except for buying puts in the options or shorting the market. Nowadays, you have contra funds, you have bear funds, you have inverse related funds to different industries, you have leveraged inverse bear funds. You have it all now, where back in the day, we had hardly anything. So I do not fear a down market. I don't, as much as I would not fear an up market. It's just knowing how to position yourself on the side of that market. So pay very close attention to not just these points that I've made, but some of the other points that would affect, again, popular opinion. Industry shifts. You know, I think one of the greatest shifts in all industries in the history of the U.S. was actually the shift Apple made, Apple Inc., when they went into the music industry. I mean, Sony Music, Sony Records had that industry locked up. And then all of a sudden, Apple introduces iTunes, and the game changes. They were like the black swan that just swooped down and took market share away from Sony, when Sony never, ever should have lost their percentage of controlling that market. Never. But they did. So you have to pay attention to new technologies. You have to pay attention to corporate news and how they're going to expand globally. Just so many different things that can affect. And the reason I tell you to focus on these things is because the news that you digest, combined with the technical analysis that you are seeing, again, as a tool, you put those two things together, and there's lots of money to be made. Because if you could see a potential gap forming and a news item comes out and backs that up, boom, you're taking a position. Now you've greatly increased the probability of making money on that particular trade. Now, weather patterns, you might think, well, that's an odd thing to add, right? Well, in the past 2 months, I've been hit with 2 hurricanes down here. Some of you may have even seen me on the news. We got a direct hit last month with Hurricane Hermine in Cedar Key, which is the town I live in. My wife, our main house is in Cedar Key, and we have another place in the Orlando area, which is only 35 miles from Daytona Beach in the Atlantic Ocean side. Well, why am I telling you about this? Because weather patterns, believe it or not, affect stock prices. And I could prove this, actually. The beginning of hurricane season here, most of you have not experienced a hurricane, maybe a nor'easter or something like that if you're up in towards Montreal and maybe Toronto. But weather patterns affect stock prices, and that June 1st is the first day of hurricane season for Florida and the southeastern United States. Now, how would that affect a stock price? Well, if you look at Home Depot, we're not going to do that right now, but do this as like an assignment. Look at Home Depot, ticker HD. Look at LOW, that's Lowe's. You'll notice that over the years, the stock tends to go up beginning of June. And if you had gone back over the past, well, 50 to even 100, no, they're not around 100 years, but I would say the past 40 years, Lowe's and Home Depot have been around pretty much that long. You go back and look, June is the best time to buy those stocks. And many times the stocks have gapped up, they gapped up because of a weather event like a hurricane. Listen, you have a devastating hurricane hit the shores of Florida. People are going there to buy batteries because they lost electricity. They're buying wood to repair their homes, plywood to fix their homes, whatever, and lanterns and generators and everything else. Well, guess what? Home Depot and Lowe's is going to benefit from a big storm. You know, it sounds unfortunate, right, for the victims, but that's the way it is. We can't control the weather, but we can forecast the stock prices based on the forecasts that we get in weather patterns. Earnings surprises, we've all seen that. How many of you have seen, listen to this, and you probably scratch your head like I've done many times, where a company comes out and exceeds the earnings expectations, and then the stock drops? How many of you have seen that? Raise your hand. Can we get a show of hands here? Let's see. See if I can see the attendees. Oh, where'd they go? There they go. Okay. Let's see. Raise your hands. Oh, I can't see the attendees. Interesting. Oh, there we go. Okay. So the stock beats the earnings expectations, but then the price drops. Well, guess why? It goes back to that very first slide that I showed you when we talk about the buyers buying and the sellers having high inventory. You see, once the earnings has been released, all of those people that have been buying prior to the earnings will then sell for a profit. That's called a profit-taking move, and the price drops. Well, gaps will often follow earnings surprises. So again, if you want to look for a gapping opportunity in this particular strategy, get yourself online and look at the earnings calendars. There's a lot of different ways. Companies always report the day and many times the exact time of when they're going to announce earnings. Be ready for gaps, and you can trade them accordingly. All right. And then again, my final point there, any kind of news that would sway popular opinion could very well disrupt the pattern or the flow of a trend as money moves in or out of a stock. Now, this is the classic bull versus bear, okay? And we all have heard the bull market, the bear market. We've heard of the reasons why people buy and why they sell. We heard all that. But when I was on the trading floor, that's not me, that's just a picture of the trading floor. But when I was on the trading floor, this is back in 1982, before Al Gore took credit for inventing the internet. Before the internet, news was given to the pros on the trading floor by teletype machines. They basically were rolls of paper into more or less an electric typewriter, and it was hooked up to receive news. And the floor traders, would watch that news all day long. In fact, there were times where I actually hired somebody just to stand by the teletype machine so that, and his name was Danny. Danny's job all day long was to run as fast as he could to tell me whatever breaking news was coming out on that particular day. Now think about that for a second. We didn't even have computers for charts. We were doing all of our charts by hand with sharpened pencils and graph paper. But I had Danny as my news source. He literally earned a living just by reading the news for me. And when the news broke, he would run over, and I would be almost always one of the first traders to trade against the news. And while I was trading the news, I had another person, and his name was Tom. Tom was calling my clients to give them the news. And that's the way the news broke. But before the internet, there was a gradual release of the news which allowed the market, including the professionals, to digest the information. So by the time I got the news and I got the news to my clients, the prices were already starting to move. And as a result of the gradual release of information, there was a tendency to have less price gaps. You see, nowadays, with the way the information is put out, it's like lightning. I mean, it's lightning fast. And in fact, companies nowadays, what they do is they get news as fast as anyone, but the name of the game today is who can hit the biggest audience the fastest. So that's why social media has become such the rage that it is, because more people are getting their news off of Twitter, and even reliable news, if you can imagine that. They're getting their news from Twitter. And you got, some of you may have heard of Drudge Report. Drudge was no great news agency. They just happened to be the first person. Matt Drudge was the first person to actually release the Monica Lewinsky scandal when President Clinton was president. That was their claim to fame. He was the first to get it out to the masses. And since then, every other agency has been following the Matt Drudge model for getting news out. So you have to tap into your sources. If you were to see my computer screen, I have CNN News, I have Drudge News, I have Yahoo News, I have Google News, I have Investor Business Daily News, I have any bit of news that I could possibly get my hands on is on one screen, and I constantly scan the news. Whether I agree with it or not, I know that something eventually is going to pop up that will release or move the market. Now, by the way, can anyone tell me what movie this slide is from? Anyone see Dan Aykroyd and Eddie Murphy there? Well, that's thank you. That is Robert. Let me see. Thank you, Robert. You got that correct. And I'll get to your question here in a moment. This is an actual. I don't know if you can see my cursor. This is my buddy Joe Spinelli. This is Tony Vaz right here. This is George McNamara. These are all guys I used to trade with. This is an actual shot from the screen and from the movie Trading Places. And I'm standing off behind the camera with John Landis, who's the director. These are all my buddies in front of the camera. I was behind. I actually got credit in the movie for helping John Landis with this one. But this whole movie, and the reason I put this in here is because this whole movie was based on how news was being released. And whether you saw the movie or not, Eddie Murphy and Dan Aykroyd here turned out to be the good guys. They were the heroes in the movie, because what they wound up doing is they found that someone was trying to switch the news on them. They confiscated the false report, replaced it with the true report, and it screwed up the whole sequence of how news was getting out. But Eddie Murphy and Dan Aykroyd actually made money in the orange juice markets when they took a short position. The news, the actual news, initially caused the price to go down, and they took a short position in the market. Now, most people watching the movie couldn't even tell you what shorting the market means, but they could tell you what caused the market to move. It was all about the news. And so this is really a great movie. If you haven't watched it, I would go rent it. I think you can buy it in Walmart for, I think you can buy the CD for like $6 or something like that. It's a great trading movie. It really teaches you a lot about trading. So now, Robert, you say if we have a chance, can we do a quick review of the gaps for GLD and SLV? Yeah, we'll try to do that towards the end. I'll keep an eye on the time. Now, the key component here is actually the technical analysis. And I'll tell you right now, I would not be trading without charts. I wouldn't even be able to forecast the market if I didn't have a chart in front of me. Many times the charts will give us or tell us when the conditions are ripe for a gap breakout. Now, I'm going to go, the next slide is going to more or less focus on that triangle pattern that I have right there. But this is an actual chart of a stock that was about to break out. Now let me explain this to you. You can see that there's gaps here, here, and over here, and I will do a better job defining these gaps on the slides ahead of me here. But this is a classic, what they call a triangle pattern. If you have not studied price patterns with any much time into that study, I would encourage you to go to the Market Guys website and look at the videos that I have there with triangle patterns and breakouts. I have very short videos that'll give you some coaching on this. But a triangle pattern forms when you have two converging lines coming to a point where eventually the price moves above the upper line or down below the lower line. When that happens, there's usually an acceleration of the trend in that direction. Let me paraphrase myself here and telling you, once the line breaks, the stock has a tendency to run. That's what happens. And many times, when a stock is in a triangle pattern like that, it will most likely gap above that triangle pattern. Most of the time it will gap up. And so these are some of the things you want to focus on so that you are anticipating the gap. Now, the other good thing about gap trading, as I'll get to, is that you have a lot of time to react. You have a lot of time. See, here's another price pattern called the trading channel, where when the line is broken, the stock runs. And in this case, the term used is breakout. Even though you're seeing the price move lower, a lot of people mislabel this and they call it a breakdown. It's actually a breakout to the downside because it's breaking out of the channel and then going lower. But in this case, it didn't gap lower, but you can see the effects of it running lower. Now, when there is a well-defined support level, let's say that the lower dotted line here is representing support. Most people who are using risk management strategies place their stop loss orders below a key support level. Now, the technical traders know this. They know that the stops are what they call stacked. The stops are stacked. There's lots of stop orders. So if someone owns a stock higher and they put a stop loss order to sell the stock if it goes lower, the people that have the stops in there are minimizing their losses. So what happens is a lot of times the traders actually try to push the stock lower to activate the sell stops, which in turn triggers the sell-off. Isn't that interesting? Now, some might say that's manipulation. Well, I would agree with you, but it happens all day long. It's not, there's no regulation that says it's illegal. It's not illegal behavior. It's not immoral. It's there. They're running the stops. They actually put heavy sell orders in to trigger the stop loss orders, and then as the stock drops, the people who sold up top are buying lower and capturing profit along the way. And then eventually they cover their shorts when they see bullish candles like we see here in what's called a hammer pattern. Now again, this one slide, I could peel off, let me see, 1, 2, 3, I could peel off 4 separate 1-hour webinar sessions just from this one slide. There's that much to know on that one slide. And again, I don't want to overwhelm you. Of course not. I want you to take this in doses, 1 hour at a time, one webinar at a time, one video at a time, until you have seen this so many times you don't even have to think about it anymore. It's just becomes second nature to you that when you see a stock breaking down below a key support level, you know at least not to buy it. You know, why would you want to catch the falling knife? We've all heard that one, right? Well, if you see a stock is starting to break down, do not buy it. That's the first part of the equation. Do not buy it. Instead, look for ways to make money on the way down. Okay, now, Robert, you say shorting the market. I'm talking about this. Make sure it's clear. It's basically when you think the price is going to go lower, but you don't have any shares to sell. So what you do is you borrow shares from your broker, almost like you're borrowing shares on consignment, and you sell those shares that you've borrowed in the open market. And when you do that, you get a lot of money in your account. So selling the shares puts money in your account. But remember, you still owe your broker those shares. So when the stock drops down, you buy the shares back. So you sold them up here, you buy them back, and then when you buy them back, you immediately hand them over back to the broker to repay the debt. That's what shorting is. And again, that's a whole nother class that I can get into and spend an hour just on shorting. So I just want to answer Robert's question there and help him with that. Okay, any other questions? If not, I'm going to move on to the next slide. Keep going, keep going. Okay, no questions. All right, here we go. Here's the gap. What is a gap? Well, it's I've showed it to you a couple times already on the charts, but the definition of a gap is really it's the break between prices on a chart. That's all that is. And it occurs when the stock makes a sharp move up or down. In this case, the gap that I've identified is a down, it's a gap down, all right? And what happens is the reason this occurs is because a lot of times the news will come out either before the market opens or after the market closes. So the news is released during a closed market scenario. So obviously, if the market closes today at 4 p.m. and bad news comes out on the stock that you own tonight, the reaction for that bad news won't happen until the following morning. So immediately all the sellers are stacking up. I just want to sell. And there's no buyers to be found the next morning. So what happens is the stock immediately drops. And that's what causes the gap. Now, there are some rules that surround gap trading and that are pretty phenomenal. Now, I have to qualify this. There is no one in the world that's going to give you these percentages. And so why am I able to do that and no one else? Because I keep very, very strict records, and I record everything I say. I put out and again record on the internet all of my market reports, my trade alerts, my opinions. When I'm on the financial networks, those are recorded. The stations keep those and archive those. Everything I do is recorded. And over 34 years of me being in the market, I've tracked gaps very, very closely. And I will show you the technique that I use for doing this in a moment. But first, here's the rule. Gaps will fill about 80% of the time. What does that mean, the word fill? Well, hopefully you can see my cursor here. Let me see if I could draw something on here to make this a little bit easier for you to see. Okay, I'm going to go with a red color. Okay, so right here is the gap. I'm circling it. Now, obviously, you can see that the stock gapped up. So the stock gapped up mainly because of some good or positive news that jolted the price action higher. But the word fill means that eventually the stock will come back to the gap that was left open. See? So on this day right here that I drew my arrow to, on that day, the price came all the way back to the original opening of the gap. So when the price action comes back to fill the void, that means filling the gap. Now, the other part of this 80%, it's an 80-20 rule that pertains to gaps, is that once the gap fills, and again, we already defined what fill means, after the gap fills, there's an 80% chance that the stock is going to go higher from there or reverse. So it's 80-20, 80% chance it'll fill, 20% chance that it won't, and then after it fills, there's another 80-20 rule. Now here's how I do this, and I would love it if each and every one of you did this for a homework assignment. Get yourself a piece of paper, anything. I don't care if it's a paper napkin. Get a piece of paper, draw a line down the middle of the paper. On the left-hand side, what you do is you note the gaps and the date at which the gap formed. So on the left side, you're identifying the gap and you're putting the date at which the gap formed. On the right side of the chart, mark whether the gap filled and the date at which it filled. And then when you compare the left column to the right column, you'll see that 8 out of 10 times the gaps will fill. It's simple looking at your piece of paper. And I don't tell you to do this just with one stock. Do it with hundreds of stocks if you got time. Look at any stock symbol, any market, and you'll see this 80-20 rule applies to almost every single stock that you are going to look at. Now, there's one exception that I would throw in there where the 80-20 rule may not work, and that's in the extreme penny stocks. I don't like to trade penny stocks. I have in the past, got burnt most of the time doing so. I more or less do it for fun as a long shot lottery ticket. But gap trading doesn't work very well with stocks trading under $1. They work very well on stocks over $1, and particularly work even better in stocks over $5. And it doesn't matter. It could be a $200 stock. It could be a $500 stock. You will see gaps. This right here, this one slide, this right here is worth all of the time that you have spent in the last year learning about the markets right here. This is some of the most valuable information you can get your hands on with regard to trading because where in the world are you going to get an 80% chance of making money? Where? You can't go to Las Vegas and find odds like that. You can't. It's a fact, and I'm doing my best to prove it to you. But in order to prove it, you have to do your homework. Okay. Now, any questions so far on this? Okay, there are some questions coming up. All right. It says, within what time frame are we expecting the gap to fill? Oh, very good, Lauren. I think you got one slide ahead of me here. Let's see. Okay, here's what I'm going to do. Find the gaps. Now, here is another rule of thumb. I didn't put it on a slide, and this is for Lauren. The smaller the gap, all right, write this one down if you like. The smaller the gap, the faster it will fill. Or there'll be less time needed to fill the gap than a gap that's a larger gap. And I'm going to show you this right here. Okay. Now, can you identify the gaps without me pointing these out to you? Can you see where those gaps are? Just type, you don't have to type where they are in the chart price, but just tell me if you see any gaps. Just type a yes in there if you see a gap, because then I'll know, number one, you're still awake and paying attention and loving this presentation, or I'll know that you've fallen asleep and taken a little nap. Okay, Lauren, Robert, Greg, I see. Okay, you see the gaps. All right, now, I'm going to circle those gaps for you. At first glance, you may have missed a couple of these, but I've identified all the gaps. Now, again, this goes to Lauren. A gap will, most of the time, this pertains to the small gaps, gaps usually begin to fill or start to make their move to fill within 3 to 5 days of the day the gap formed. All right, so let's look at this. Let's start all the way to the left. Here's a gap. 1, 2, 3. On the 4th day, it makes its move to fill the gap. Again, 1, 2, 3. On day 4, that was the last time it hit that low, and then the very next day it filled the gap. Here's another gap. On day 1, 2, 3, it starts to fill the gap. Here's another one. 1, 2, 3, 4 days, and then starts to reverse and go the other way. Here's a small gap. 1, 2, 3, 4, 5. On day 5, it hits the low and starts going higher. Right here, a gap is formed. 1, 2. On day 3, the high is formed and then starts to reverse and comes back down. You see? So the general rule for the small gaps is that 3 to 5 days is your window, and I would call those 3 to 5 days your watch day, because there's two ways to play the gaps. There's one way is to play the gap. Let me go back here. One way to play the gap is to play it for the target being the fill price. Another way to play the gap is once the gap is filled, to play the market on the reversal after it's filled. Now, I hope I generate at least one question there, because I listen to myself and I understand what I'm saying, but I have to think like I'm a person right now who's never even seen a chart. So I'm hoping there's at least one question on that. Here's why. Gap. If I'm playing the gap fill, I'm going to wait for a bearish sign, maybe this doji. I'll take a short position. On the next day, I'll buy it back after the gap fills and make profit. Okay, that's one way. Another way to play the gap is, let's say this one here. I think the gap is going to fill, so I wait for the stock to fill. I wait for it to fill. So here it goes up higher, goes up even higher, starts to fill. On this day, it fills. So I am playing this on the reversal. So after the gap fills, I wait for the next bullish sign, whether it be a green candle or in this case a doji. That's a little bit more advanced, and I get into the details of trading. But once that doji forms, or I might wait for the next day, that green candle, I buy on this day or that day. Or I might buy on both. I might buy a little on each day. So in this strategy, I'm waiting for the gap to fill, and I'm playing the reversal. I'm waiting for the stock to go up now as I profit in that. And I'm going to put the chart on the line on here. So I'm waiting for the gap the price to reverse after the gap fills. So my window of opportunity is just on those few days right there. Okay, so that's an example of that. Now, this again goes to Lauren, because this was your question, and just got a couple. Like you were a couple of slides ahead of me in your question, but here are some of the general rules. Never trade against a gap on the first day. So what that means is, if a stock gaps up and you're thinking about shorting it, let me do it the other way. It's easier for people to understand on the downside. If a stock gaps down and you think the stock gap is going to fill eventually, do not buy that stock on the first day it gaps down. Wait 3 to 5 days until you start seeing some positive signs. Then buy the stock. And a lot of times you'll see these dojis or spinning tops to appear. If those are foreign terms that I've just used, then go to the Market Guys and look at the videos that pertain to dojis and spinning tops, and you'll get a lesson on that. So you don't want to trade on the first day of the gap. You want to wait 3 to 5 days for the price to settle, and you're looking for a bullish sign to appear on point 3. Then what you do is you place the trade, but immediately set a stop loss. Now, I know there's some differences in the way stops are handled in Canada, but you could use price alerts all the same. So in other words, what you're doing is you're placing the trade, but understanding that there's a 20% chance you could be wrong. Remember the 80-20 rule for gap trading. So there's a 20% chance you could be wrong. And so you have to protect against that. And then once the trade, the price fills the gap, you just get out of the trade. That's really as simple as it gets right there. And remember, you're getting a copy of these slides. You're getting a copy right here. So you'll be able to add your notes. You want to print this out on paper, you can do that, add notes, it's fine. So again, here's some gaps. You see? Hold on. So here's a gap right here. I'm going to see if you can identify them. Let me get my pencil again. I'll even show you the smallest of small gaps here too as well. So there's a minor gap right over there. You see that one? There's a gap. And what happened? It filled right here. After it filled, took a couple of days, but then it reversed, right? Here's a gap. So here's a larger gap. And it went 1, 2, 3 days before it started to fill. It eventually filled, and then what happened there? It rallied. Here's a gap. Interestingly enough, it didn't take 3 to 5 days. It took a long time for this one to fill, but look what happened right after it did fill. It filled there, and then the price reversed and went lower. Here's a gap, most recent gap right here. The price right here. I can't remember which stock symbol this is, but I'm almost certain that it dropped after the gap filled, just like all of the other times the gap filled and it dropped as well. So that's how you would look at gaps. That's how you would understand how to react against the gaps. And remember, as I said, if you go to the Market Guys website, I have videos that pertain to gap trading and other concepts that I've already mentioned here for you. So, feel free to go there and get familiar with it, because this isn't going to become second nature to you until you have practiced this a bit. And once you practiced it and you see it, and your belief level and your confidence level goes up, that's when you could start really putting your money at risk and feeling good about it. So, Rose, I think we have time. Robert was asking if I could look at GLD, and and SLV. Let's look at that. Let me see if you have your screen. Okay, now let's take a look at this now. This is GLD. And oh, good one. Okay, now here's what I'm going to do. Where's the Q&A box? I'm going to test the audience on this one. Who can tell me where in October, at what price level do we see an open gap? At what price level? See if we can see that. Who wants to answer that? All right. And Rose, somehow I lost my control panel, so you'll have to field the question for me if anyone sees that. Anyone have an answer on that? Well, it's really the first or second trading day of October. The stock gap down. Now, if Rose, can we zoom in just to October for a moment? Just to October. And you can see the gap will be more pronounced. There we go. That's good. Right there is fine. That's fine. Okay. Now, if you look, right after the gap formed, again, second trading day in October there, it took 1, 2, 3, it took 4 days for the stock to hit the low. Now, this is a really good example. And again, thank you, Robert, for bringing this up, because this is a hammer pattern where Rose has her arrow. That's called a hammer pattern. That's bullish. 3 days to the right of that, we have a green candle, a very small green. That's called a doji. That's also very bullish. So if, again, we're using this for educational purposes because it's being recorded. If I were a trader looking at this chart right now, I would be more inclined to buy at these levels and set a price target for 125, which is the point at which the gap would fill. You see that? So let's take this one step at a time. I'm getting long with a price target for when the gap fills. As soon as I put my long position in, I have to manage my risk. As soon as I do that, it's almost simultaneously. So if the stock drops below, let's say it drops below 118, I'm going to get out. So those are my rules. I'm going to buy it, but I'm going to let it go maybe $2 against me before I get out, and I have a price target at 125. That's my strategy. And that is, by the way, one way that you can trade the gap. The other way to trade the gap is once the gap fills, and by the way, you can set a price alert for this. Set a price alert on GLD for 125. Once the gap fills at 125, there's a good chance it's going to reverse from that point and go lower. See, and Rose just put an alert. Look how easy that was. She clicked on the blue tab. You could even type in a little info page. You can put the price right there, 125, and put in a note. Look for price to reverse at gap fill. You know, that's what you could put in there, or gap fill target, whatever it may be, and then it'll add your note to the chart. You see that? So when the alert goes off, you're going to get notified with your alert. Let me tell you, folks, if I had this technology back in 1982, I'd be worth 100 times more than I am now. No kidding. This is unbelievable technology that is being used for your benefit, and it's doing most of the work for you. All right, so you don't have to lose sleep at night waiting to monitor prices. All right, now let's look at SLV. Oh, by the way, before we go to SLV, look at JNUG. This is the stock that I talked about with the recommendation I put out yesterday for our subscribers, because this is also a gold stock. JNUG. Is it in there? It's a junior nugget. Maybe. There it is. Top. There it is. Okay. Now, yesterday, I put the alert out. Why did I do it yesterday? Because there was a very pronounced green candle yesterday. Rose, you could zoom in there a little bit too. So we bought it at $10. We bought it intraday, right there. We bought it that day. My target for this one is $16. This is what I put out. And it could even go a lot higher. It could go to 24. This thing is leveraged. It's 3 times the gold miners. So if I get in at 10 and I sell it at 16, that's a 60% return, and it might take me a week or two. But once it hits 16, we are out. We are in cash. We are happy. We're having a big celebration because we profited finally, right? And at that point, though, once the gap fills, I might decide to take a short position. Not only will I get out, but I might reverse my position and look for it to drop after that. See, that's how we play. Now let's look at SLV. I got to do this real quick because we're right at 2 o'clock. SLV, same thing. Look, gap up there around 1770. Zoom in a little bit, Rose, to October, and you'll see the same exact thing. Now, if I'll tell you when to stop in a second. Ready? Stop. Okay, stop right there. Now look, folks. 1, 2, 3, 4, 5. 5 days ago, which is that long shadow candle. Rose, if you go down just a little bit down, it's 5 days ago, right there. 5 days ago, I bought the heck out of silver. I bought the heck out of it. I bought a big chunk of SLV right here. So I am telling you that my opinion is slightly tainted and biased because I am long it. Why did I go long there? Well, it had 2 long shadow days in a row. But look to the left. Look at June 26th. Look at June 26th to the left. Right there. See that gap? Right there. 4 days ago, that gap filled. Now, this is an interesting one because now there's an 80% chance that after that gap fills, it's going to go higher. But there's also an 80% chance that the gap above the market is going to fill. So I got a double whammy, 80% probability of making money on this one. So I bought into it. I backed the truck up and I bought in. Now, could I be wrong? Sure, but I have to manage my risk. So that's how you look at gaps. That's how you trade gaps. That's how you manage risk with gaps. And hopefully we provided you with some really good information that you're going to run with. Listen, stick with the market, guys. Stick with Scotia. You're getting first-class education all the way. I'm going to hand it back to Rose so she can tell you how to get your hands on the gift that we're giving you here with the PowerPoint presentation. Thanks, Rose, for driving the platform, and thank you, everyone. We'll talk to you soon.
You're welcome, AJ, and thanks, everyone. So next, you can access our webinar recordings on our website. And also, don't forget to fill out the survey that will pop up after you exit today's session. And also mark your calendars. Next Tuesday, October 18th, Recognia joins us to present on understanding price action to make more informed trading decisions. They will be highlighting the Recognia Insight tool on Scotia Online platform. And AJ joins us again on Thursday, October 27th at 1 p.m. Eastern Time to present on options trading using technical analysis. And also we have upcoming Evelyn Jacks presenting on the Managing Risk to Your Wealth. It's our first ever fireside chat, sort of a video format of our webinars, happening on Wednesday, October 19th. And this will be available for you to register on our calendar sometime tomorrow. And you may also register for other webinars on our webinar calendar under the Learn and Do More section of scotiaitrade.com, and also past recordings on webinars on demand. And with that, I'm going to thank AJ for sharing his insights, and thank you all for joining us. And I just want to check the question panel just to make sure that there are no other questions that we missed. Okay, thanks. And I will share the presentation with you. Yeah, thanks everyone. Have a great day.